The math on your mortgage statement adds up perfectly. Every dollar accounted for. Every payment on schedule. The bank's computers never make mistakes. But there's a calculation missing from that statement. The opportunity cost of what else that money could have become. A $400,000 mortgage at 7% interest doesn't cost you $400,000. It costs you $958,000 over 30 years. But here's what they don't show you. If you took those same monthly payments and invested them instead of paying down the mortgage early, you'd have over $1.2 million. The difference isn't discipline or financial literacy. It's understanding that the bank designed your payment structure to guarantee their profit while making you feel responsible for choosing the expensive path. And they've convinced millions of people that paying off debt early is always the smart move, when the math often says the opposite. This is not financial advice. This is education. I am not your financial advisor. Welcome to Wellflow Invests. In this channel, I break down how money actually works, so you can make informed decisions with yours. If you find this kind of breakdown useful, consider subscribing. I publish a new one every week. Your mortgage payment feels simple. One number. One monthly obligation. Pay it for 30 years and the house is yours. But that single payment hides a mechanism designed to extract maximum profit while feeling manageable. Every mortgage payment splits into two components: principal and interest. Principal is the amount you actually borrowed, the money going toward owning the house. Interest is the cost of borrowing, the money going toward the bank's profit. Seems straightforward, but here's what they don't advertise. The split isn't even. Not even close. On a $400,000 mortgage at 7% interest, your first payment is roughly $2,660. Of that, $2,333 goes to interest. $327 goes to principal. You borrowed $400,000, and in month 1, you paid back $327 of it. The rest? Bank profit. This isn't a mistake. It's called an amortization schedule, which is just a fancy table that details how banks front-load interest to guarantee their profit, even if you refinance or sell early. The formula is simple. Your interest payment each month equals your remaining balance times your interest rate divided by 12. So in month 1, you owe $400,000 times 0.07 divided by 12. $2,333. Next month, your balance is $399,673. Interest, $2,314. Principal, $346. You're 2 months in and you've paid off $673 of a $400,000 loan. The system isn't broken. It's working exactly as designed. Here's the part that shocks people. In the first 20 years of a 30-year fixed-rate mortgage, your interest payments exceed your principal payments on every single monthly payment. 20 years, 240 payments. And the majority of every single one goes to the bank, not toward your loan. By year 20, you're 66% through the mortgage in terms of time elapsed, but you've only paid off 42.75% of what you borrowed. At a 7% rate, you'll pay $558,500 in interest over 30 years. That's more than you borrowed. The house didn't cost $400,000, it cost $958,000. If your rate is 5%, you pay $373,000 in interest. If it's 3%, you pay $279,000. The rate determines whether you buy one house or nearly 2.5 houses with the same loan. This is why paying down your mortgage early feels so appealing. If you can reduce the principal faster, you reduce the total interest paid. You shorten the loan term. You save tens or even hundreds of thousands of dollars. It's mathematically sound, but it's not the full picture. Because while you're saving 3%, or 5%, or 7% by paying down your mortgage, you're ignoring what else that money could become. The S&P 500 has returned an average of 10.26% annually since 1957, according to historical data. After taxes, a reasonable expectation is 7 to 8%. If your mortgage rate is 3% and the stock market averages 8% after tax, paying down your mortgage early earns you 3%. Investing earns you 8%. The 5% difference compounds over decades into life-changing wealth. Let's make this concrete. You have an extra $500 per month. Option 1. Invest it for 25 years at 8% returns. Option 2. Pay down your mortgage early and save $188,000 in interest. Both scenarios assume an 8% rate, 8% mortgage interest, 8% investment return. Same rate. Wildly different outcomes. Why? Because of how amortization works versus how compounding works. When you pay extra toward your mortgage, you reduce the principal and save interest over time. Those savings accrue slowly at first because most of your payment is still interest. When you invest, your returns compound immediately on the full balance. Year 1, you invest $6,000 and it grows to $6,480. Year 2, you invest another $6,000, but now you're earning returns on $12,480, not just $6,000. By year 10, you're earning returns on over $90,000. By year 25, the compounding turns your $150,000 of contributions into $473,000 of wealth. The mortgage savings are real. $180,000 is not nothing, but it's the difference between what you would have paid and what you did pay. It's money you never see. The investment account, that's money you have. $473,000 sitting in an account you can access, spend, or pass on. The financial industry doesn't emphasize this distinction because they profit from both sides. They want you focused on paying down debt, which keeps you risk-averse and dependent on credit products, while they invest their own capital for compounding returns. Now here's where it gets personal. If your mortgage rate is 2.5 or 3%, the math is unambiguous. Invest. You're locking in a guaranteed 3% savings by paying down the mortgage, but sacrificing 7 to 8% compound growth. That's not a close call. If your rate is 6 or 7%, the decision shifts. You're saving 6 to 7% risk-free and tax-free by paying down your mortgage. That's harder to beat in the stock market on a risk-adjusted basis. Some years, the market returns negative. 2018, 2022. If paying off your mortgage guarantees 7% savings and the market might lose money, the guaranteed return starts looking attractive. But there's a variable most people ignore: time horizon. The more time you have left on your mortgage, a greater the benefit from investing, because compound growth needs time to overcome short-term volatility. If you have 25 years left, the market's bad years become noise. The compounding overwhelms the mortgage interest savings. If you have 5 years left, the math flips. You don't have time for compounding to work. The guaranteed savings from paying down a 6 or 7% mortgage become the better move. This is the part the financial industry obscures. The question isn't whether to pay off your mortgage early or invest. The question is what your money could become given your specific rate, time horizon, and risk tolerance. But risk tolerance is code for how much volatility you can stomach without panicking. And the industry loves conservative investors because panicked investors make bad decisions that generate fees. Refinancing, selling low, buying high-fee products that promise safety. The system profits when you're scared. So here's the framework they won't give you. If your mortgage rate is below 5% and you have more than 10 years left on the loan, invest. The math overwhelmingly favors compounding. If your rate is above 6% and you have less than 10 years left, consider paying it down. The guaranteed savings outweigh the uncertain upside from investing. If you're somewhere in between, run the actual numbers with a mortgage calculator and a compound interest calculator. Don't rely on feelings. Don't rely on what sounds right. Do the math. But paying off a mortgage isn't purely financial. There's a psychological benefit to eliminating the payment entirely. No mortgage means you need less income to survive. It's optionality. If you lose your job or want to retire early, not having a mortgage payment buys you time. That's valuable. But it's a different kind of value than wealth accumulation. It's peace of mind versus portfolio growth. Both are legitimate, but you have to know which one you're optimizing for. The financial industry sells you the dream of paying off your house early because it feels like winning. And in some cases, it is. But in many cases, it's the suboptimal move dressed up as financial virtue. Banks don't pay off their debts early. They leverage cheap debt to invest in higher returning assets. Corporations don't pay off their bonds early when rates are low. They refinance and invest the savings. The wealthy don't pay off mortgages early when they're sitting on 3% rates from 2021. They invest. The system teaches you to fear debt, while institutions use debt as a wealth-building tool. If you do decide to pay down your mortgage, there are strategies that minimize the pain. The first is bi-weekly payments. Take your monthly payment and split it in half. Pay that amount every 2 weeks instead of once a month. You'll make 26 bi-weekly payments per year, which equals 13 monthly payments. That's one extra payment annually, going straight to principal. On a $400,000 mortgage, at 7%, bi-weekly payments save you 6 years and 1 month of payments and $134,000 in interest. You pay off the mortgage in 23 years and 11 months instead of 30 years. One small change. 6 years saved. But here's the catch. You have to call your bank and explicitly tell them to apply extra payments to principal, not future interest. Otherwise, they'll just apply it to the next month's interest, and you gain nothing. The system defaults to the option that benefits the bank. You have to actively override it. The second strategy is paying an extra $100 or $200 per month. On the same $400,000 mortgage, an extra $200 monthly saves roughly 6 years of payments and $126,000 in interest. This works better when your rate is 6 to 7% because the interest savings are larger. At 3%, the savings are smaller and you'd be better off investing that $200 instead. The third strategy is lump sum payments. Tax refund, bonus, inheritance. Any windfall of cash can go straight to principal. A one-time payment of $12,500 knocks 21 years and 2 months off a 30-year loan. That's 2 years and 10 months saved, and $78,900 in interest saved from a single payment. But again, if your mortgage rate is 3%, and you could invest that $12,500 at 8% for 25 years, it becomes $68,000. The interest savings was $78,900. The investment growth was $68,000. Close call, but the investment money is liquid. The mortgage savings are locked in the house. The benefits of paying off your mortgage extend beyond the numbers. First, peace of mind. Not having a mortgage payment is psychological freedom. Second, cash flow. Eliminating the payment frees up that money for other uses, including investing. Third, lower debt-to-income ratio, which improves your credit score if you want to borrow again, which I hope you don't, but the option exists. Fourth, a paid-off house and asset you can pass to your kids or use as collateral in retirement. Those are real benefits, but they're different from maximizing wealth. The trap is thinking, paying off your mortgage early is always the responsible choice. Sometimes it is. Sometimes it's the financially suboptimal choice, disguised as virtue. The system loves conflating the two, because it keeps you focused on debt elimination instead of wealth accumulation. You feel like you're winning when you make an extra payment. You feel responsible, disciplined. But if that payment would have compounded into 10 times its value over 25 years, you didn't win. You lost. The bank won. If you remember one thing, the right financial decision depends on your specific rate, your time horizon, and what you're actually optimizing for. When you're deciding whether to pay down your mortgage or invest, ask yourself whether you're chasing peace of mind or maximizing wealth. The answer will tell you which path serves your actual goals. Everything else is details. Every week I expose one system designed to extract your wealth. Subscribe so you see the next breakdown. Paying off your mortgage isn't always the smart move. Sometimes it's just the move that makes the bank feel safe about your future payments.